Thank you for joining us. This is Business Incorporated on Channels Television. I'm Chimeze Obi Iwago. On the show today, South Africa expects lower tax revenues and higher borrowing this year. Egypt's GDP growth seen slowing to 5.5% in current fiscal year. Plus, lawmakers back plan to nationalize Kenya Airways. Get the show started now with the market, and it was a bright midweek start for the Nigerian stock market as the index sustained the positive sentiment recorded on Tuesday. The NSE index was up 0.46% at intraday. However, the other markets were in the red zone, led by South Africa JSE index. Egypt was marginally down 0.03%, while Kenya closed negative on Friday. And in the Middle East, it was all green at intraday. Dubai stocks rose 0.82%, led by property shares for a third consecutive day of gains. Financial stocks helped Saudi shares. The Saudi index gained 0.03% after 4 days of losses. Qatar's index rebounded 0.37%. In Abu Dhabi, the index traded 0.25% up, continuing 6 straight days of gains. In Europe, stocks opened slightly higher in the morning as market participants braced for a dovish outcome from the European Central Bank's upcoming monetary policy meeting. Earnings are also still rocking the markets, with Deutsche Bank reporting a loss of 3.2 billion euros. Well, here is Chelsea to give us all the details and more. Hello, Chelsea. Good afternoon.
Yes, Deutsche Bank was out with its results this morning, and they reported this 3.2 billion euro loss, which was a bit surprising to markets. Deutsche Bank had said earlier this month, when it reported that it was going to be doing this huge restructuring program, that it was going to take a loss of about 2.8 billion euros. So there's definitely a question of where this other 400 billion euros went over the past 2 weeks. What happened? Why did the outlook change? So people are concerned about that, and we did see a pretty big sell-off in the market today. So the stock opened up down around 5%. It's recovered a little bit, but investors are thinking now about what's sort of the outlook here for Deutsche Bank. If you strip out some of these special costs for the restructuring program, the outlook still is not very bright. So some of these core businesses that Deutsche Bank is really relying on, the transaction bank, the corporate bank, their results were pretty much stagnant in this quarter as well. So there's a lot of questions over, Deutsche Bank is doing this restructuring, it's getting rid of businesses, and it's supposed to be refocusing among some of these corporate bank, the transaction bank, and those results aren't doing that well. So, we're definitely seeing this reflected in the stock today.
All right, the International Monetary Fund has cut its outlook for global GDP for 2019, now saying that global growth will slow to 3.2% from 3.6% last year. So what's driving the slowdown, and how worried should investors and businesses be?
Well, it's sort of the same narrative that we've had going on for the past really 3 years now. The first thing that's really weighing on global growth is, of course, the trade tensions between the U.S. and China. The IMF estimated that around 340 billion dollars worth of tariffs have been slapped on goods internationally since October. So that really does crimp trade, and we're seeing that reflected in a lot of the earnings that companies are reporting now. Companies like some of the big automakers here, chemical companies, agriculture companies. It's really having a widespread effect on global economies. It's also a perpetual worry of investors and companies about what's happening in the Chinese economy. The Chinese economy has been a huge driver of global growth, and now that they are seeing all these tariffs, the economy is slowing, and sort of how that ripples through the global economy is definitely a concern. And then also Brexit, and now that's sort of been brought back to the forefront of investors' minds with the new Prime Minister Boris Johnson. That also creates a lot of uncertainty for companies and investors. So the next thing that people are going to be thinking about is how do central banks react. We'll have the ECB tomorrow, likely to indicate a a rate cut this year, which would have a lot of impacts for companies. But for now, all the data is sort of pointing to this global slowdown for companies and investors.
Now, across the Atlantic, the U.S. is opening an antitrust review into whether big technology firms like Facebook and Google are stifling competition. Could these companies be broken up?
That's definitely on the table. The DOJ, the Justice Department, hasn't really said what exactly the potential outcomes of this investigation are. But there's been a lot of calls among politicians, among advocacy groups, to break the tech companies up, and those have sort of gained momentum this year, especially after all the problems we've seen with Facebook. That's sort of what has galvanized this political support behind this idea. With data scandals, with election interference, there's just been a slew of scandals involving these companies and the way they protect data, the way they interact with customers, the way they work with other companies. So there's definitely political momentum to break these companies up. Whether the law will allow for that is a little bit of a different story. The narrative has always been that it would be very difficult to break these companies up just because of the way that antitrust law is structured in the U.S. You typically have to prove that the companies are sort of raising prices for their customers, and because so much of these platforms rely on, they don't have a charge, there's nothing really to raise the price for, it might be difficult to make that case. But what analysts are saying is that what we could see is regulatory fines, other restrictions on business. They think that those might be more possible routes for this.
All right, Chelsea, let's keep an eye on the ECB tomorrow. Thank you for those updates. And stocks in Asia Pacific were mostly higher following developments on the U.S.-China trade front. Mainland Chinese shares rose on the day, with the Shanghai Composite adding 0.8% to 2,923.28, while the Shenzhen Composite advanced to 1.106% to 1,562.97. Hong Kong's Hang Seng Index added 0.42% as of its final hour of trading. Meanwhile, ASX 200 in Australia rose 0.77% to close at 6,776.7 as most sectors saw gains. The Nikkei 225 in Japan closed 0.41% higher at 21,709.57, while the Topix Index added 0.4% to end its trading day in Tokyo at 1,575 points. Over in South Korea, however, the Kospi fell 0.91% to close at 2,082.3. And U.S. stock index futures were cautiously lower in the morning as investors kept a close eye on U.S.-China trade links and monitored corporate earnings. As of 4:40 a.m. Eastern Time, Dow futures were down by 49 points, suggesting an implied open of around 58 points lower. Futures on the S&P 500 and Nasdaq were also marginally lower. Now, American and Chinese negotiators will meet for face-to-face talks next week after the two presidents reached a truce in their trade war on the sidelines of a G20 meeting last month. Meanwhile, investors will be looking at data and corporate earnings. AT&T, LVMH, and Boeing are due to report before the bell, while Facebook, Tesla, and Equifax will update investors after the bell. In terms of data, there will be manufacturing and services PMIs at 9:45 a.m. Eastern Time and new home sales at 10 a.m. Eastern Time. Away from the equities market, there back here on the African continent, Egypt's economic growth is expected to slow to 5.5% in the fiscal year that began this month, below the government's target, and 5.8% the following year as Cairo nears the end of an IMF-backed economic reform program. Well, this is according to a survey conducted by Reuters. Well, Prime Minister Mustafa Modboli said last week Egypt's gross domestic product grew 5.6% in the 2018-2019 fiscal year. Barring the oil industry, Egypt's economy has struggled to attract foreign investors since the 2011 uprising that ended Hosni Mubarak's 30-year rule. Egypt's non-oil private sector activity contracted for the second consecutive month in June. According to the Emirates MBD Egypt Purchasing Managers Index, private sector activity has expanded in only 5 months over the last 3 years. And Kenya's parliament voted to nationalize the country's main airline, Kenya Airways, to save it from mounting debt. The loss-making airline, which is 48.9% government-owned and 7.8% held by Air France KLM, has been struggling to return to profitability and growth. A failed expansion drive and a slump in air travel forced it to restructure $2 billion of debt in 2017. The airline later proposed taking over the running of Nairobi Main Airport to boost its revenue. Parliament's Transport Committee, however, rejected the plan, recommending instead the nationalization of the airline in a report debated by the National Assembly on June 18. In a voice vote taken on Tuesday afternoon, the majority of lawmakers in the chamber voted to accept the report. And back here in Nigeria, local communities that occupied and stopped operations at an oil flow station in the Niger Delta have continued to agitate for compensation from international oil major Shell over loss of livelihood and environmental pollution. Almost 2 years ago, the communities occupied the flow station for the oil mining license 25 and stopped operations in a bid to force the Shell Petroleum Development Company to sell the license to a local oil firm.
The people of the Belema and Ofionama communities in Nigeria's oil-rich Niger Delta region are not pleased. Community leaders say that Shell's claim that it has invested $300 million in the development of the community is false. They have also refuted an announcement earlier this month by regional officials that the dispute had been resolved and that the flow station will be reopened. The community gathered recently to appeal to President Buhari to intervene and show journalists around.
His Excellency, President Muhammadu Buhari, GCFRO, President and Commander-in-Chief of the Armed Forces of the Federal Republic of Nigeria, set up a special fact-finding committee to visit the area to see the level of neglect, backwardness, and suffering of a people that have hosted SPDC for over 40 years, with a view to setting us free from the evil of SPDC.
The embattled facility accounts for over 45,000 barrels of crude oil and over 135,000 metric tons of gas per day. Those living around the flow station say it has only caused misery because their waters are polluted and no amenities have been provided.
For fish, where we small, now fishing we do. But for now, we need the fishing gari shop. Our children, because of that, then they do anyhow to get money. We women, we suffer. When we want born, no hospital, yeah. Suffer where we suffer 2 months. Gary will not get to give our children. Nobody will ask.
56-year-old Francis Edeha is one of the estimated 83,000 Belema, Ofionama, and Ngeje people living in the area.
All this mangrove is spoiled, killing. The fish, and fish where they come here, the oil go, they kill the fish. Even crayfish, even crab, all go die.
Nigeria, with a population of some 190 million people, consumes close to 40 million liters per day of gasoline and is easily the largest fuel market in West Africa.
In South Africa's headline consumer inflation remains steady at 4.5% year-on-year in June, unchanged from the May figure. Our data from Statistics South Africa shows on a month-on-month basis, prices inched up 0.4% from a 0.3% increase previously. Core inflation, which excludes the prices of food, non-alcoholic beverages, petrol, and energy, was at 4.3% year-on-year versus a 4.1% increase in May and was at 0.4% month-on-month compared to a rate of 0.0% last month. And after the break, detail eye on South Africa economy, plus update from the Nigerian equities market.